Hey, this is Chris from StockSpot, Australia's largest online investment advisor. And in this video, I'm going to be talking about the difference between saving versus investing over the long run, using some real life examples, the returns from our portfolios versus the average savings accounts over the last 10 years. So people often, I think, don't appreciate the big difference in compounding over long periods of time. And this can really be seen by comparing saving versus investing. So over the last 10 years, and the time frame is up until the end of September 2024, if you'd left your money in a bank account in Australia, and I'm using the official RBA average bank interest rate, and so that looks at 3-month deposit rates across major banks, you would have actually only earned on average 1.6% per annum. And I know these days interest rates are a bit higher, they're at like 3.5 or 4%, but actually over 10 years, the average was 1.6 because there were a lot of years with almost negligible or zero interest rates in Australia. So putting in $10,000 10 years ago would have grown to $11,720. And remember, that's before tax, and interest isn't taxed very well in Australia. So you probably would have paid a fair amount of tax on that amount. Now, let's say 10 years ago, instead of leaving your money in the bank, you put your money into our most conservative strategy. That's the Amethyst strategy. It has more bonds than it does shares, and it's relatively conservative for a diversified portfolio. Now, it returned over 10 years 5.7% per annum. So a $10,000 investment 10 years ago would have turned into $17,573. So over $6,000 more than leaving the money in the bank. But I think the compounding can be seen even better if you look at a high growth portfolio. Now, keep in mind that a high growth portfolio has a lot more volatility. So you see bigger swings ups and down. In fact, the biggest fall over the last 10 years was about a 17.5% fall that happened during 2020. So you've got some stomach churning ups and downs along the way. However, if you had the patience to see those through, then a $10,000 investment over the period would have earned on average 8.7% per annum, leading to a final balance of over $23,000. So you almost doubled your money versus leaving it in the bank by investing it over 10 years. And I think that truly captures the beautiful concept of compounding over the long run. 10 years in the scheme of things isn't even that long, but even in 10 years, you're able to double what you'd have by leaving the money in the bank. And better still, if you've got your money invested in markets and you're not selling that investment, then you're not paying very much tax at all. You're only paying a little bit of tax potentially on the income you're earning, the dividends and interest income, but none on capital return or capital gains. And so your tax is deferred further and further into the future, whereas when you're saving, you're having to pay tax on your interest every year. And that's really the difference between saving and investing over the long run. And you should keep in mind that obviously year to year and decade to decade, those returns will be different. But what we do know is over long periods of time, historically at least, investing into a diversified portfolio has been a strategy that's had better returns than saving for those who have a long-term horizon.